Welcome back. I'm Peter St. Onge. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. Inflation jumped to its highest since Joe Biden's auto pen. Is it time to eat the pets or shut down Congress? Last week, the notorious Bureau of Labor Statistics released inflation numbers for the month of May, coming in at a torrid 0.5% on the month, which is over 6% annualized. Left-wing media positively crooned. The Daily Beast wrote, quote, "Trump humiliated as inflation rockets to a new high." Now, the good news is inflation's down from an annualized 8% the previous month and 11% in March, the first month of the war. The bad news is this now takes us to 4.2% on the year, the highest inflation since we escaped the clutches of Biden. The kicker is the entire inflation story is energy, which has come down from 111 in March, but is still grinding along at $90 a barrel compared to 65 on the eve of the war and 57 in the halcyon days of last December when you could run the aircon and the car radio. But inflation is not spreading outside energy. So groceries last month rose a satisfying 0.1%. Everything else outside food and energy, so-called non-core inflation, was at 0.2, which is a smidge above the Fed's 2% target. So why aren't prices rising everywhere else? Because unlike the crayon eaters at Daily Beast, companies understand that inflation is temporary from energy, and companies don't raise prices for temporary inflation because they lose market share. Unfortunately, there's one outfit that is stuck with the Daily Beast coloring book, and that is the Federal Reserve. Ever since the war started, I've said the war itself and even $100 oil will not cause a recession. What will is a Fed that panics and hikes rates. Now, the Fed does this because oil inflation goes on top of the regular inflation they steal through money printing to take from the poor and give to the rich. Put oil on top of the regular siphon, and it gets awkward. Unfortunately, hikes crush the economy and jobs since they raise borrowing costs, which cuts investment and bankrupts employers. You get leftover goods and leftover workers, so both get cheap. Now, you could reduce inflation by lowering money printing, so-called quantitative tightening, but instead the Fed hikes to crush jobs. The tragedy is even with $90 oil, the Fed does not need to feed workers into a wood chipper. Recent videos have argued you could drop prices economy-wide by 20% with policy reforms in housing, healthcare, insurance, and, yes, energy. In housing, simpler zoning and environmental rules could cut prices by nearly $100,000, according to the National Association of Realtors. Lower deficits could lower mortgage costs. In healthcare and insurance, requiring price transparency, cracking down on so-called charge master abuse, $80 for a Tylenol, and certificate of need and scope of practice rules hospitals use to cartelize, let patients buy insurance cross-state, and then energy, where Trump's done a lot to free up permits and drilling, which are up 55% on the year, but it needs a congressional blitz to clear decades of weaponization of environmental laws and permits that keep millions of barrels in the ground. So as such, everybody knows inflation's temporary except the Daily Beast and the Federal Reserve. If the Fed can control itself, oil will continue bouncing off the economy. And if Congress can bestir itself to cut some red tape, we could get some good out of 4.2 inflation. Unfortunately, Democrats on the Fed and Congress will do their best to screw it up. Japan just blew through $100 billion, failing to defend the yen, which matters because they're funding the yen jihad by selling treasuries, U.S. government debt, to the tune of $47 billion in March alone. That knocks out one of the most reliable buyers of U.S. debt. Japan's got over $1 trillion, at a time when the U.S. needs to find buyers for $12 trillion of federal debt in the next 12 months. Now, to put that in perspective, all the bank accounts in America, households, companies, everything, come to just over $20 trillion. Treasury needs to refinance 12. So why is Japan in trouble? In short, Japan spent 30 years building an orchid of an economy that cannot survive in the real world. Problem is they did this by using the central bank to manipulate interest rates near zero. That means companies can borrow almost free, which lets zombie mega corporations hog up the money and the workers. that sucked the oxygen out of Japanese growth. It's basically an open-air museum with almost no startups. And it created a Godzilla-sized house of cards where entire slabs of Japan's economy simply cannot survive with normal interest rates. They wouldn't be able to service their existing loans. That's called malinvestment in Austrian economics, businesses that only exist because money is artificially cheap. And Japan is made of the stuff. One study by Teikoku Data Bank estimates 1 in 6 Japanese companies are zombies, meaning they can't cover interest payments even at 0% rates. This dry kindling came to a head starting in Bidenflation when Jerome Powell hiked interest rates at the fastest pace since the 1970s. That opened up a 5.5-point gap between U.S. rates and Japan. In other words, anybody and their uncle could borrow in Japan at 0.1%, park it in treasuries for 5.5%, and take home free money. The hedge funds of the world did notice, borrowing and then furiously selling up to $4 trillion worth of yen, which is roughly the size of the Japanese economy. That sent the yen crashing from 103 to the dollar to 160. Now, in a normal economy, Japan would have hiked rates to keep up with Jerome, but with a sixth of the economy made of zombie, Japan could not raise rates. They would mass liquidate companies, banks, and pensions. Voters would bust out the pitchforks even in Japan. So instead, Japan let the yen go with a half-hearted promise to someday think about raising rates, which incidentally caused a 12% one-day drop in the Nikkei, but at least it put a floor on the yen around 150. That brings us to the current crisis. Because the Iran war sent Japan's energy imports soaring, Japan imports almost everything it uses, so more yen selling for oil. Meanwhile, it sent growth crashing to barely above recession, so stagflation that chases out any foreign investors still parked in yen. That all sent the yen skidding past 160, at which point Bank of Japan finally broke the piggy bank. So as an expert, what happens in Japan does not stay in Japan. In the near term, because of the comical amount of U.S. debt looking for a home when Japan's selling, but zoom out, and America's deficit is now 3 times Japan's, as in we've got a decade or two, but the canary is telling us that when the stuff does hit the fan, the dollar will follow the yen into oblivion. A word from our sponsor. If you own gold, and many of you do, you already understand how it protects your wealth from the insanity coming out of Washington. The inflation, the recessions, the wars. But with monetary metals, there's a way to actually earn a yield of up to 4% on your gold paid in more ounces of gold. You retain ownership of real, allocated physical gold with no storage costs while your ounces grow every month outside the banking system. If you're serious about protecting your future and building your legacy, head to monetarymetals.com/Peter to get started. One of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. One of the most trusted names in hardware wallets is CoinKite, maker of the famous block clock. CoinKite devices are made in Canada. They're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/ProfSaintAnge. That's CoinKite.com/ProfSaintAnge. Okay, back to our show. Job tests are illegal again, unleashing a world where you don't have to pay a university $150,000 to prove you can read. Last week, the Department of Justice ended so-called disparate impact rules that pressured companies to hire on race, but also effectively outlawed job competency tests. This matters because what forces young Americans to get useless college degrees is our DEI overlords twisting a 1971 Supreme Court decision, Griggs, to effectively ban job tests as racist. That created an opening for colleges to effectively sell $150,000 job tests bundled with 4 years of gender indoctrination and lots of beer. So the 1971 case actually said employers can use tests to measure qualifications, which is common sense, but the Equal Employment Opportunity Commission at Justice would scrutinize the job questions. So if, say, blacks do worse, it proves the test was racist. You are now liable to lawsuits. This set up a legal minefield since blacks do worse on pretty much every aptitude test because their children are locked in socialist day prisons run for blue city teachers' unions. So companies responded by replacing tests with credentials, overwhelmingly college degrees. College enrollment doubled, college revenue jumped 14x. In short, colleges got rich selling the only legally safe IQ test, bundled with 4 years of political indoctrination that studies show swinged students 30 points Democrat. Now, this forces young people into debt slavery to pay $150K in tuition. It's actually $300, including 4 years lost wages, to replace a 15-minute aptitude test. Worse, access to college is even more racist than aptitude tests, with almost 3 times as many whites finishing college, so 72% versus 28% were blacks. So a black kid who is brilliant but whose parents did not steer him to college is SOL thanks to the liberals at DOJ. Now, the problem is this move is just guidance, as in it can be reversed by the next Democrat in the White House. What companies need is certainty that they won't get slammed with lawsuits in 2 years. For that, Congress would have to get off its butt and clarify that job tests are legal so long as they are rationally related to business needs, no matter who passes with what numbers. It's worth noting this is how it works in professional sports. The NBA obviously discriminates on height, but they bought themselves exemptions when everybody else has to pretend that top engineers are perfectly distributed by gender and race. So as next, Trump opened the barn door to dethroning college as paid commissar of social sorting, but Democrats will slam it shut as soon as they can because discrimination has become a key part of Democrat vote buying. Meanwhile, the colleges selling $150,000 IQ tests are the indoctrination factories and the golden parachute for Democrat politicians and activists to get six-figure jobs on the public dime. If Dems will not play ball, then like pretty much every problem in the country, Congress won't fix it because of the filibuster, leaving it to the Supremes to finally clarify that job qualifications means merit and not race. 94% of jobs last year went to women who, fun fact, make up less than half the workforce. In case you wonder why women can't find a guy with a decent job, or why, according to a recent study, there are now 7 million stay-at-home boyfriends running through Shorty's stack. The statistics come from the Bureau of Labor Statistics, who report that of the 369,000 jobs created last year, just 21,000 went to men. That's 1/17 of jobs. Worse, this has been going on for years. Since 2016, women in the labor force have been unchanged, but 2 million men have dropped out. What's driving it is two things: explosive growth in female-dominated fields and state-sponsored discrimination. The female fields include healthcare, which is 80% female, leisure and hospitality, waitresses, cleaning ladies, personal services. Together, these accounted for 99% of payroll growth last year. And the other part, of course, is DEI, men intentionally passed over in the name of diversity. Now, diversity is funny when 16 out of 17 jobs are already women, and it especially hits in government jobs, which still make up 1/5 of all jobs, including education, and corporate jobs, where CEOs try to impress left-wing executives at the Wall Street proxy advisors that functionally run corporate America. One study found that in the year after Black Lives Matter, white men got just 6% of corporate jobs, despite being a third of the workforce and, given education levels, likely more than half of qualified applicants. In fact, women now make up a majority of corporate jobs. So much for the Hollywood glass ceiling smashers. The real glass ceiling is men breaking 6%. This is all, of course, crushing men. Men make up 3/4 of alcohol deaths. They're 4 times more likely to be homeless, 4 times more likely to commit suicide. In fact, suicide rates for men are now the highest since the Great Depression. Of course, men get little help or even sympathy. Instead, they are under constant assault. 60% of male college students say they're, quote, afraid to speak freely on campus. 1 in 3 young men say society views them as, quote, toxic. One study found 90% of mainstream media articles on men frame them as problematic. Another found TV ads portray fathers as incompetent in 9 out of 10 ads. 65% of divorces are initiated by women. Men lose custody in 85% thanks to loaded courts, which then becomes a vicious cycle. Fatherless children are up to 20 times more likely to be incarcerated and make up 85% of juvenile offenders. And of boys who grow up without a father, their suicide risk doubles again to 8 times women. So what's next? Help is on the way between deportations, which boost blue-collar jobs for Americans, factory onshoring with tariffs, which also boost blue collars, H-1B reform, which helps men find tech jobs, even AI data centers, which are hiring millions of men to build machines that replace female-dominated admin jobs. Meanwhile, Trump is doing his best to dismantle the entire DEI complex that shuts men out of the few industries that do hire men. And if the Supreme Court keeps striking down anti-male discrimination, it is possible we could return to the days when men could support a family instead of spending their girlfriend's paycheck. A word from our sponsor. Stocks and even gold are all over the place. If you're ready to diversify, Abundant Minds makes Bitcoin mining simple, transparent, and human. You can deduct every penny thanks to Trump's big, beautiful bill. It's a 401k for Bitcoin mining. Founded by husband-wife team Bo and Christine Marie Turner after losing $500,000 to broken promises in the mining industry, Abundant Minds was built to protect investors. You own the machines, and they make it turnkey with hosting in their facilities in Oregon. Pricing is clear with one flat monthly fee and no surprises, and they guarantee uptime so you keep earning day in, day out. If you want easy diversification without pressure, learn more at abundantminds.com/Peter to get some of your first Bitcoin mine for free as a gift to my audience. The biggest risk in Bitcoin isn't volatility, it is custody. Because Bitcoin removes the safety net, there is no bank to call, no reset button if something goes wrong. The reality is, most people are not properly set up. They hold Bitcoin but rely on exchanges, incomplete wallet setups, and have no real plan for privacy or inheritance. This is exactly what the Bitcoin way solves. They help you move from exposure to actual ownership, self-custody done right, privacy, inheritance, even running your own node, all set up with you step by step. They never touch your Bitcoin. They're your support team. Go to thebitcoinway.com/Peter to book a free call and go from where you are today to a much stronger setup. Now back to our show. Washington now spends $2 for every one it collects, as in taxes would have to double to cover what Congress already spends. Perhaps it is time for Washington to cut costs. The D.C. credit card statement arrived last week, courtesy of Treasury, who tallies $628 billion out the door in May, compared to just $335 billion collected. That is a $293 billion hole in a single month, $3.5 trillion annualized. Now, deficits this big, 7% of GDP, have happened before in American history, for example, World War II. What's never happened is 7% deficit when unemployment's low, the stock market is hitting highs, and with nothing resembling total war, nobody is rationing rubber. In other words, we are running emergency room deficits on a regular Tuesday, and that matters because eventually we will get a recession because it's what the Fed does for a living. When that happens, the average recession now blows out the deficit by an additional 6% of GDP. So 6 on top of the 7 we've got gets into silly town. So where did it go wrong? In short, FDR and then Richard Nixon killed the gold standard that used to limit government borrowing, meaning now every crisis, every problem is a ratchet that makes spending go up and it never comes down. To illustrate, in COVID, they rubber-stamped welfare, and now 6 years later, social spending is still $2 trillion above pre-COVID, a full trillion, even accounting for inflation. Military spending keeps going whether or not we have any wars worth fighting. Green subsidies, crony infrastructure bills, NGO slush funds, Washington breeds mouths to feed. Now, we had the perfect storm with Doge and unified Republican control, including a GOP Congress who had spent 50 years promising lower spending. Instead, they hiked spending. Now, to be fair, they hiked only a tenth of what Dems were promising. But if the perfect storm cannot make a dent, that leaves one last hope: grow out of it. Get economic growth fast enough that we can outrun the deficit. Now, it's sound in principle, and Treasury Secretary Bessent has been pushing it. The problem is if you're running a 7% deficit, you've got to grow 8%, Toss in the occasional recession, and you need closer to 10%. That is China level in its very best days. Now, it's possible to grow 10%. We did it in the 1800s when we had no income tax, a tiny regulatory code, and a tiny federal government to go with it. But today, we would need a miracle. Prediction market call sheets got us pegged under half that through 2030, and that's with AI. So what's next? When you see a crisis coming, there's two options. Start preparing today, or let it hit and then fix it when minds are concentrated. Washington is, of course, going to let it hit. Faster growth will buy us time. Republicans versus Democrats might buy us a little more time, but spend twice what you make, and the music eventually runs out. And when it does, you'll see it first in bond markets, yields in the double digits, which freezes the economy, crashes Wall Street, and crashes pensions. And then you'll see the Fed parachute in to convert it into inflation, at which point anybody holding dollars or buying groceries gets wiped out, while the rich who own hard assets, houses, stocks, hedges like Bitcoin or gold, get to inherit the rest of the economy courtesy of the Federal Reserve and the federal spending it feeds like an addict. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersanons.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.